Hey traders, my weekend video, it will be a short one. Very busy this weekend. Um, Please like me if you get a chance. Retweet me on Gumby9662C on Twitter. And some comments below. I really appreciate it. I'm just going to do a simple analysis on SPX, kind of what I'm thinking right here. So the white line represents the 89 moving average, the weekly 89 moving average. Okay. And the yellow line represents the weekly 200-day moving average on the weekly time frame, of course. So the alien 9 has been a very critical uh, moving average to keep on your charts. Okay, so what I did is some comparisons uh, off of our most recent cycle correction back between 2020 and 2021. Okay, and so basically, if you go from the low, to the high, and anchor the same equal distance, what we did uh, in that scenario, we have not gotten quite the entire length of the 2020 to 2021 correction. So this cycle length, we have not actually achieved that same cycle length yet. So be very mindful of that. Okay, so that's one thing. Then I also looked at the distance from breaking above the 89 moving average to the highs, above the 89 to the highs. We haven't gotten to that level yet. So both of those suggest a higher. I forgot to change the from the percentages back here. Wait a minute here. Sorry about that. There we go. And so both of those suggest we still got upside to mirror the 2020-2021 cycle. Okay, so still feeling should be still fuel in the fuel tank to the upside here in the markets, given the short squeeze we got going on this breakout. Okay, excuse me. Now I also measured the distance. This is the 89 moving average, the max distance ever from the 89 moving average to the high. If we do the same thing, okay, off the current 89 moving average to the high, okay, right here was the max distance ever from the 89 moving average. So we're currently in uncharted territory, the distance away from the 89 moving average. Okay, so be very mindful. So this makes a lot of sense right here because we're mirroring that max distance. That this is where a bunch of dark pools came in. So a bunch of billionaires, they thought, hey, this is a very critical area that I want to be taking profits off the table. And then we had some new investors coming in here, billionaires coming in saying, no, this is the area I want to be buying. Nobody knew which way it was going to go, but now we finally broke out. Well, these new guys who come in, they've got a plan. They're looking for like a 2-to-1 risk to reward ratio. That's a minimum. That's a minimum projections. Okay, a minimum possibility. So what they did, they've done the math, and if you go down the daily time frame, what was going on here? uh, right here before the election. Okay, so basically about a 5% drawdown from right election day. We actually went up. Okay, before the results came out, final results came out, but basically a 5% drawdown from election day would have put us down into 200-day moving average. And investors seemed to think that they were willing to risk a 5% drawdown that the 200-day moving average was going to survive. So that's what they were doing. These new dark pool traders, these billionaires, okay, thinking the max drawdown would be down to the 200 moving average. Instead, we broke out. So now they're, in this scenario, those same billionaires are looking for a minimum 10% gain. Okay. And in that scenario, that puts us up in this range around the 6,400 for a minimum 2-to-1 ratio risk or 1-to-2 ratio risk reward scenario. 5% drawdown versus a 10% gain. Okay, and so that puts us up into this area up here, potential up into this area. Okay. And one final thing I'm going to mention here on the SPX. Now, since we've got a pretty good idea of what target smart money is looking to achieve, I I adjusted this Fibonacci retracement. I expanded it out to where the 23.6 actually is lining up with that prior resistance. Okay, that prior breakout point. Okay, so now this adjusted Fibonacci does put our target 6,500 uh, puts us with back inside of our 10% target. Okay, and basically the fib now is lining up with this potential for a possible blow off move all the way up to 6,500. So be very mindful. This could be a very quick move using our fibs. This could be a relatively quick straight up move to 6,500 here in the SPX with very little reprieve to the at all, if any, to the downside. So be very mindful of that. What I'm looking at here, a potential move all the way up into the 6,500 that would actually potentially pay that new smart money that came in. Uh, you know, uh, and the market actually went in their direction with a Trump win. So uh, that's just my quick and dirty analysis. I don't know, just doing the math, figuring things out, what I'm thinking of. I do think 6,500 is quite possibly in the cards. Um, so I do not want to discount it at all, and I don't want to be a swing net shorter in this market right now. And Now, since I think every dip's going to be bought, because anybody who knows how to do the math, realizes, it's going to be very difficult since we have the breakout here to slow this down, especially knowing that there is plenty of money on the sidelines to support the markets if they want to. So be very mindful. Remember, right before the election, we got news out that the money markets had record savings levels in the money markets just before the election. That is not indicative of a weak market. Okay, that there's plenty of money on the sidelines potentially looking for a home. So in that situation, and then the margin debts are not out of control either. The biggest worry we have in this market for correction is the bond market. I mean, that by far is our number one biggest worry, because Trump and his tariff policies. So basically, that's very inflationary, and the bond markets are, you know, it's going to be really bad if China's already not buying U.S. debt, and if the central banks in Europe, once Trump tries to impose tariffs against Europe, the central banks in Europe say, "Hey, we're not going to buy your debt anymore." Guess what? All of a sudden, the 7, 10, 15, 20-year treasuries, uh, they're going to demand a hell of a lot higher yields to for people to buy up all this debt. We got trillions of debt that they need to find a home, and currently nobody wants to buy them because people don't realize anybody who had bought treasuries over the past 15 years, any of these central banks that currently own treasuries, virtually anybody who got in the past 15 years is underwater right now. It's not only that the fact that they've lost their uh, uh, you know the time value of the investment. It's not only about losing the time value of the investment. It's about they've actually lost their initial investment by buying into U.S. Treasuries. That is a very unsustainable situation, and that will be the fundamental thing that breaks this market down, if anything. And so be very mindful. That's a big problem in our market. So be very very mindful of that scenario. Okay, but I just I'm not I'm not really overly buying into the whole Trump coming in here and saving the economy thing, with knowing he's actually the most inflationary. His policies are the most inflationary of them out there. And it doesn't take much for them to lose control of the bond market. So they created this Slack vehicle called the Federal Reserve balance sheet. And anybody who knows anything about business, Slack is a that it's kind of like inventory. You you know how can I put this? Uh, 1 second here, and get my mind here going. So anytime in business, if you need a slack point in a business model, a lot of times you'll have a distributor hold extra inventory on hand so you can buy the inventory from the distributor to take care of that short-term need. But most of the time you're looking for just-in-time inventory. Well, the slack helps keep things going in times of fluctuation in any type of system. Okay. Well, right now they've created the Federal Reserve to handle the slack of the one-time auctions. The auctions are so big, and there's so many of them. These auctions, they created this fictitious Federal Reserve balance sheet that can temporarily absorb that uh, uh, all that money being and in so doing artificially deflate the yields in the bond market. Okay, well, this is a temporary vehicle. It's not supposed to be meant. You're not supposed to have uh, uh, unlimited monies sitting on the Fed balance sheet because it's fake. Okay, and it's a very, very dangerous situation. And with Trump's policies, that's just going to explode the Fed's balance sheet because it's at the current yields. The only way they're going to be able to get this all to come down is to raise the yields substantially. And I'm telling you guys, under Trump, there is a real possibility 10 to 12% yields on interest rates on 20 and 30-year mortgages. 10 and 12%. I'm telling you, it is not out of the realm of possibilities here, because there is so much debt out there. If we start getting, we start paying these bondholders 10, 12%, you're going to start seeing all this money in the money markets start flowing right back in to the treasuries again. And we can finally get this debt off the public side and back into the private's hands. But right now, the yields are so low, they can't do that. But that's what our government really needs to do. We need to get the public to buy up this debt. And they're not doing it because the yields are too low. Okay. So I'm sorry, I'm rambling. So that's the biggest prediction I've got over the next 4 years, that they're going to lose control at the long end of the curve, ultimately leading to a correction in market. But they have to do it to get all this debt absorbed, into the public. So, or be it anywhere in the world. But I'm just saying, there has to be a net buyer there. And right now, the central banks continue to lose money, and they can't do that forever. And a lot of regional banks are going to go belly up if they continue on this trajectory, because these regional banks cannot be eating billions on their balance sheet from the Federal Reserve. They just can't do that. So uh, it can snowball really quick, because you have to think about, as far as a bank goes on their balance sheet, their primary, it's not the loans, it's not their commercial side. The biggest chunk of their balance sheet is, in most of these banks, is the amount of federal treasuries they're holding on their balance sheet, which are at a net loss. So just be very mindful of that going forward. Okay, guys? Okay. Thanks a lot for listening. I will try to check in this week. I am very busy. So thanks a lot.